everyone, it's Michael Beresford here from OpenCorp. For today's Property Wealth WOD, now a little bit of a different slant today. One of the most talked about programs that I can remember in recent times in amongst the property community has been the program that recently aired on Four Corners with regards to, I guess, Australians' passion for housing, what that means for prices, obviously the inevitable talk of a bubble and all those related things. So we've had a few requests from clients and people that have been talking with us for a while for, I guess, our opinion on that article. So I'm going to share that with you today. And what I've tried to distill it down into four key items here that will cover a lot of the key points that were covered off on that Four Corners program. The first is cycles. Okay, so I always, I guess, find it amusing when you hear the media come out with a program or a headline, whatever it might be, that talks about booms and busts, as if this stuff, someone just flicked a switch and all of a sudden things changed at 11 o'clock this morning. I remember a few years ago the Melbourne market wasn't very buoyant, and the opening headline on 7 News was housing boom. So I guess before I get into these topics, let's just keep some perspective on, I guess, who you hear your messages from and what their vested interest is in telling you that. So we're going to try and provide a balanced view and opinion on all this. The media, they like to sell newspapers to generate hype and, create either a heightened sense of excitement or a heightened sense of fear, to try and drive you to watch next week's program that's probably going to be on the same topic but with a different outcome. Okay, so we'll get into it. Cycles. Now, let's be really, really clear. The talk of the bubble has come out more recently when the Sydney market has been particularly strong over the last 4 or 5 years, and the Melbourne market also strong. Now, property prices don't go up in a linear fashion at an average growth rate. Okay, what they do is they fluctuate over time. So if this is a 10-year cycle, then you're going to have a period within that 10-year cycle of very, very steep growth. Then this is when we start to hear the talk of boom and so forth. And after that, we have a period of correction and then stabilization before the next growth phase occurs. Okay, so if you think about the Sydney market, Sydney has had a fantastic last 4 years. It had a fantastic 4 years or so between 1998 and 2002. And for the 10 years in between 2002 and 2012, it did pretty much nothing. Okay, so I guess let's just keep these things in perspective. It's history repeating itself, and property prices cycle. They're not going to stay in this boom forever. They have a growth phase, they have a correction phase, and they have a stagnation or stabilization phase in every 7 to 10 year period in average terms. Okay, so that's the first thing. Also around cycles, I guess, are interest rates and incomes. Okay, so interest rates are not always at record lows. They've been very high in the past. Average interest rate to a mortgage borrower in Australia is a tickle over 7% over a long-term average. So yep, we're well and truly under that on today's interest rates, even though there have been some out-of-cycle rate rises from banks in recent times. Why that's relevant is because interest rates will fluctuate with what's happening in the economy and what's happening with house prices as well. Okay, so it's really important, I guess, to remember not to look at one of these factors in isolation and say, oh, the housing market's booming, because interest rates are one of those factors that will be used to either stimulate or cool the housing market at any point in time. Okay. Lending practices. This is a really, really big one. There was an American gentleman based out of London that was quoted on the program, and this is a fairly regular occurrence. What you'll see now is an image on the screen that shows that what house prices have done over the last 15 years or so, interspersed with different commentary and forecasts and predictions by so-called industry experts. Okay, so it's pretty interesting to see that the Australian property market has been a resilient beast over the long term, despite all these certain predictions that come out. Now, it's really interesting that a lot of these predictions, Harry Dent is a name that comes to mind, are from Americans that look at the Australian housing market through an American lens. And there are some very, very, very significant differences between these two markets, which I'll try and give you an explanation about now. The first is that Australia has about 75% of our population concentrated in the four main capital cities of Sydney, Melbourne, Brisbane and Perth. Okay, the population of the United States is about tenfold Australia's population, but they have very, very disparate towns and cities, remote areas, etc. If you were to look at, according to Wikipedia, the population of major cities in the world, Sydney and Melbourne would be number 2 and number 3 respectively on the list of the most populous cities in the US, behind New York. So both Sydney and Melbourne have got a higher population than Los Angeles. Okay, so think about what that means for supply and demand, and think about what it means for availability of housing supply and prices as a result. The other thing around lending practices I want to talk about, I guess, is how the landscape works in these two in these two countries. So, the global financial crisis was obviously a very well-known landmark world event that happened as a result of the way that American banks and lenders lent to borrowers. And the big, term that came out of the GFC were the fact that Americans would offer, or American lenders, I should say, would offer ninja loans. And that was loans to people that had no income, no job or assets. So destined for failure, if you look at it from a fairly practical sense, especially when they're offering interest rates for people that weren't really going to be able to repay those mortgages at all. Why did they do that? Because they have in America a non-recourse borrowing arrangement. So basically, if you don't want to live in the house that you own anymore and you can't make the repayments, you can walk into the bank, leave the keys with the bank manager, and then the bank owns that house. Okay, so when that happens en masse, then obviously banks are holding a lot of asset that's not generating any income for them, and that's a liability. Okay, obviously a very, very different situation in Australia. For those of you watching, if you've actually been to the bank and tried to get money, you'll know that they'll want to ask you a lot of questions and get you to provide a lot of proof around what your earning capacity is, what your job outlook is, living expenses, etc., all of your liabilities and assets and income, so that they can make an informed decision on how robust you are as a buyer, or as a borrower, I should say, and therefore in your ability to meet the loan repayments. Okay, so a very, very stringent lending system we have here in Australia versus a very different situation that was happening in America. So bottom line is, if you can get money in Australia today, then you've had to prove that you can do it.